What's up everyone, it's Karthik with MoneyVest. So in this video, we are going to be talking about correlations. This is a very important concept. It's going to serve more as an educational video than anything else. So definitely pay attention, as I'm sure you're going to find a lot of value in this video. As always, make sure that you drop a like and subscribe to the channel. I do spend a lot of hours creating these spreadsheets for you. So hopefully you can, of course, learn more about the markets and how different asset classes operate and work and what's the market structure, and at the same time also get a little bit of analysis and fun out of these videos. So make sure that you share this video with your family and friends and other traders and investors. I would really appreciate that. It's word of mouth like yourself, recommendations that helps us grow this channel here. So today we're talking about correlation coefficient, and I really want to break down this spreadsheet over here that's going to better help you understand the correlation between 8 different asset classes. So what I did was essentially, obviously, put together a lot of data. So you can see that this is all the data going back as far as 2002 to even further back to 1999. So we're going back over 25 years worth of data for these 8 asset classes. As you can see that we've got equities, which is represented by SPY and QQQ. We've got the bond market, which is TLT. We've got gold. We've got VNQ, which is real estate investment trusts, so REITs. We've got the dollar index. We've got the treasury yields, and we've got Bitcoin. So these are the 8 asset classes that we are going to analyze across the board, and this is called a correlation matrix, which I'm going to explain in a little bit more detail. But before we get further, I do want to break down the idea behind this. So Ray Dalio has very famously quoted this term called the Holy Grail. This is a video that I highly recommend. This is not a long video, only 4 minutes long, where Ray Dalio himself, the guy who runs one of the biggest hedge funds in the world, Bridgewater Associates, and of course has written extensively on portfolio diversification, even on countries and their economies, talks about this holy grail where as you diversify more among different asset classes, your risk within the portfolio goes down while maintaining the same level of reward, or while maintaining the same level of potential expected returns. So this right here is a screenshot of that Holy Grail. And we've got the number of assets in the portfolio down here in the x-axis. And we've got the standard deviation of the portfolio on the y-axis, or in terms of the volatility of that portfolio. So what he essentially says is that as you grow across the x-axis, as you're adding more and more assets that are uncorrelated to each other, the idea here is the uncorrelation, you can potentially reduce the significant risk in the portfolio, or the volatility. Volatility is just another measure of risk. You can reduce that by maintaining the same level of expected returns. Now, correlation, the reason why this is so important is because when you are constructing a portfolio for yourself, right, most of us are accustomed to buying stocks, right? Stocks is kind of like the staple for every portfolio. But there's a ton of other asset classes out there, right? There's bonds, there's fixed income bonds, there's real estate, there's gold, there's Bitcoin, there's again, the dollar index, right? So we've got emerging markets, we've got international equities, we've got domestic equities. So there is a lot of instruments and vehicles out there that you could potentially invest in. But the idea here is for us to understand what is the correlation of one asset class relative to the other. Because when we're talking about correlation, it's never in isolation to one stock or one asset. It's always compared to another asset class to understand what is the correlation. So a correlation is always going to be between a -1 and a +1 number. That's the correlation coefficient. It's going to be somewhere between -1 and +1. So a perfect negative correlation is going to be -1. That means that when one asset class goes up, the other one goes down. There's a negative correlation. There's a perfect negative correlation where one goes up, the other one goes down. And when the first one goes down, for example, the other one goes up, down, up. So there's a opposite direction between those two asset classes. A good example of this is going to be the treasury yields with the bond prices. So bond prices and treasury yields move in inverse to each other. When one goes up, the other one goes down, right? So when TLT goes up, the treasury yield goes down, right? And vice versa. A positive correlation, so a perfect positive correlation, is going to be +1 or close to +1. And that means when one asset class goes up, the other one also goes up, right? So up and up, down and down. So when one is going down, the other one's going down, and they're both moving in the same direction. Now, a positive correlation can actually be detrimental to a portfolio, because if you are investing in stocks, ETFs, real estate, gold, whatever those asset classes might be, let's say that you're constructing a portfolio and all you have are assets that are positively correlated to each other, then your entire portfolio becomes extremely risky, because if one thing goes down, the other thing goes down and everything goes down in your portfolio. So that's why Ray Dalio essentially suggests that you want to build a portfolio of assets that are uncorrelated to each other, which is no correlation at all, which is zero. That means when one of them is going up, the other one may or may not go up. When one of them is going down, the other one may or may not go down. So there's no really pattern that you can detect between those asset classes, right? So there's no pattern, there's no correlation between them. And that's when you are able to really well take advantage of course, lowering your portfolio volatility and risk while thereby increasing your potential expected return. Negative correlation is also not the best, because these are mostly called hedges. So, we like to look at options as a perfect way of hedging our portfolio, because let's say that I'm selling calls, right? So if I sell a call, right, my underlying position may have an unrealized loss. If the stock price starts going down, my unrealized stock position will be in red, but my call option will be further out of the money and it will be green. So that's a perfect negative correlation, because as the price is going down, my stock position is going down, but my call option is going up. So that's an negative correlation, but that is also called a hedge. So you're not making any money, right? You're making money on the call option, but of course you're losing money on paper, at least unrealized basis, on the stock position. So perfect negative correlation are hedges. Perfect positive correlation don't really lower any volatility or risk in your portfolio. So we really want to aim for asset classes so we can diversify among non-correlated assets that are as close to zero as possible. So the way you calculate this is essentially come over to the historical returns for all these 8 asset classes. So what I've done here is that I've gone back to over 24 years. You'll notice that not all assets have data available. For example, Bitcoin was live in 2011, so you can't really get data prior to 2011. As you can see that we don't have any data for Bitcoin prior to 2011. And then of course, there's things like VNQ that don't have data all the way through 1999, or TLT, we don't have the data all the way to 1999. But this right here is still a good understanding of how these correlations operate between these 8 asset classes. So if you look at SPY with SPY, obviously that's going to be 1-to-1, because it's S&P 500 and we're comparing it with the S&P 500, right? So they're perfectly correlated, because when SPY goes up, SPY goes up. When SPY compared to QQQs, right? So NASDAQ 100, you'll notice there is a correlation, positive correlation of 0.84. Right? So not everything is going to be perfect 1 or perfect -1. They're going to be somewhere between -1 and +1, as I mentioned. So they can be in points, 0.4, 0.5, 0.7, 0.8. So in this case, we've got a 0.84 positive number between SPY and QQQs. And that makes a lot of sense, because when most of the days we see that, right? We see that every day. When the S&P 500 is up, the NASDAQ 100 is also green. When the S&P is down, NASDAQ 100 is also down. So that is the positive correlation of 0.84. But when you compare this to TLT, for example, which is the bond ETF, now we've got a negative correlation, right? So we've got a negative 0.27. That means when SPY goes up, TLT in the last several decades here, going back as far as 1990s that we've done the analysis for, goes down. So there is a negative correlation between the S&P 500 and TLT, the bond ETF. So that's a good hedge, right? So for example, right now, what we have seen is that last week S&P 500 was down 2% and TLT was up 6%. Right? So that is that negative correlation where you're seeing TLT outperform the S&P 500 now. As it's going down, TLT is going up. So that is the negative correlation. And also investors like to take advantage of rotating out of equities over to more defensive bonds and fixed income to take advantage of this volatility and of course generating alpha by rotating into bonds, right? Out of equities. So that's the negative correlation. Now, if you come over to gold, we have practically no correlation with the S&P 500, so it's about as close to zero as it can be. So, what we've seen is over the last several decades, as S&P 500, doesn't matter whether it goes up or down, gold is trading on its own dynamics of supply and demand and its own catalyst. it's very, very uncorrelated to the equity market and what the stocks are doing. So 0.05. So that's why I actually prefer gold. So one of the reasons why I've actually been buying gold in the last couple of years is because it's very uncorrelated with equities. So it doesn't really matter what stocks do. Gold is in its own world, right? Going up, down, all over the place. It's doing its own thing. So that's why it's very uncorrelated to the equities market. Yes, it has its own cycles of when it actually trades sideways or higher or sideways again. But the bottom line is that gold in itself is a very uncorrelated asset class compared to equities or real estate for that matter. You'll notice that across the board, it trades mostly at zero. So that is, compared to the NASDAQ, 0.04, compared to the bond market at 0.17. So slightly positive correlated, but again, really, really low. The only time it is negatively correlated is with the US dollar. Right, so the US dollar has actually got one of the most significant negative correlations on this matrix is with the dollar index. Everything else is about as close to zero as possible. As you can see that compared to the 10-year treasuries, it's got 0.07, compared to the NASDAQ 0.04, compared to real estate 0.13, and then compared to Bitcoin 0.10. So again, it's very, very close to zero, uncorrelated to other assets. Against the US dollar, though, it is negatively correlated, right? And quite significantly, a negative 0.47. So that means when gold goes up, dollar index goes down. When dollar index goes up, gold prices come down. And that's what we have seen in the last several years. Another asset class that I really want to pay attention to for you is Bitcoin. Bitcoin is extremely uncorrelated across the board for all ETFs, all asset classes here. So if you take a look at Bitcoin against all other 7 asset classes here, against equities, against bonds, against real estate, against gold, against the dollar index, against treasury bonds, everything, it is just absolutely uncorrelated. We haven't seen any correlation in Bitcoin compared to any of these asset classes. So you can see that it's very close to zero, as close to zero as it can be, especially if you compare this to the 10-year treasuries. And of course, the bond market, 0.01, and 10-year treasuries, absolutely no correlation whatsoever. And the cool thing is that you can actually start visualizing this on a plot chart as well, right? So on a dot plot as well. So if I start plotting this on actual charts, what you'll notice is for every positive correlation, the chart's going to look something like this. So we've got a SPY and a QQQ chart here. And you can see that it's a little bit more elongated, right? So it's going from the bottom left to the top right. That's because this is a sign of a positive correlation. So you're not really seeing any outcomes or any dots on these areas. So you won't see anything over here or over here because that is a sign of a negative correlation. So this is a little bit more elongated because when SPY is up, QQQ is up. When QQQ is down, SPY is down. When QQQ is up, SPY is up. So that's a sign of a positive correlation. So we're not seeing anything in the top left or the bottom right. But if I plot for, let's say, TLT and the treasury market, which is the US 10-year treasuries, which is negative 0.8, as prices go up, yields come down. So that's a very good negative correlation. That is going to be the exact opposite of what we just saw with SPY and QQQs. That's going to be a negative correlation looking something like this, as you can see. And it's the exact opposite, spanning a little bit more from the top left to the bottom right for this chart. So this right here is going to be that negative correlation, and you're not going to find a lot of outcomes over here or over here. So that's a very good negative correlation, as we've already witnessed. Now, if you come over to some other pairs, so we've got, let's see, so the one that we were talking about earlier was Bitcoin with US 10-year treasuries. Absolutely no correlation at all. And if there's no correlation, you're not going to find outcomes in any of the quadrants. Everything's going to be kind of scattered in the middle, right? That's what we are seeing for this particular pair, is that most things are scattered here in the middle. We got nothing over here. We've got mostly got nothing here. We got mostly got nothing here, nothing over here. Just a few outcomes here and there, but majority of the outcomes like just are scattered in the middle because there's absolutely no correlation whatsoever between Bitcoin and the bond market. So Bitcoin seems to operate on its own, and we're not seeing any correlation between those prices and of course the treasury bond. This right here is SPY with TLT. So we've got the S&P 500 with the bond market. So another negative correlation. But the reason why this is not as scattered as the bond market and bond prices is because it's not a perfect negative correlation, and it's also not as high as negative 0.8 as what we witnessed earlier. So it's still a little bit more elongated from the top left to the bottom right, but majority of the outcomes are still within the context of this over here. Still negative correlation, but not as much, not as significant as what we have witnessed before, because it's only negative 0.27, right? So that's going to be that number that I just showed you on the chart, negative 0.27. So that's going to be the video. Make sure that you do take a screenshot of this. Hopefully this was a little bit more on the helpful side and you got to learn more about correlation and how it works. And the idea is that if you are, let's say, building out a portfolio, you want to have assets that are uncorrelated to each other, so that, for example, if equities are falling right now as they are, other asset classes seem to hold up really well, and thereby you're getting that diversification that you're looking for from the markets, right? So a very simple example I can give you is that if you come over to the charts over here, and what you'll notice is that, of course, the S&P 500 has been selling off. So SPX, as you can see, that it's down, 3 weeks in a row. We're seeing quite a significant sell-off here, down a little bit over 5.9, almost 6%. Bitcoin is also selling off, but again, this has been in the past very, very uncorrelated relative to other asset classes. And then if you come take a look at gold prices, so GOLD, you'll notice that it's still trading pretty much near all-time highs. So that's a good way of diversification, because I also do own a lot of gold here, and you'll notice that it's pretty much trading at all-time highs, only down less than 1.5% from its all-time highs, and it's held up really well at $2,442 per ounce. Not to mention that TLT, with the negative correlation, is actually moving higher at the moment, as in the last few weeks here, we've seen TLT move up close to over 12.5%, as the S&P and the NASDAQ, of course, has moved into a correction territory. So hopefully this gives you a bit of an idea on what asset classes to look at when you are constructing a portfolio. Again, negative correlations are hedges. Positive correlations can sometimes be detrimental, because once asset class comes down, the other asset classes are going to also come down. It's going to hurt your portfolio a little bit more. But then non-correlated assets is really where the magic happens, according to Dalio, and this is a good matrix to also look at. So hope you all enjoyed this video, found it helpful. If you did, make sure that you drop a like, and again, subscribe to the channel. Let me know your thoughts down in the comment section below. Share this video with your friends and family, and I would really appreciate that. As always, happy investing. I'll see you all in the next video.